The top 20% of Americans now control 57% of all consumer spending in this country. 57%. While the headlines tell you the economy is strong, stock market near record highs, the Dallas Federal Reserve just confirmed what the bottom 80% already feels. 8 out of 10 Americans are losing ground. And if you're not in that top 20%, your purchasing power is collapsing right now, not someday. Now, this is not new. This is a pattern that's repeated itself throughout history. And every time an economy split this severely between the elite and everyone else, what came next was mathematically inevitable. We are in stage 3 of a 4-stage collapse. Let's start with what the Dallas Federal Reserve actually said. This isn't conspiracy. This isn't interpretation. This is official data from a regional Federal Reserve bank published in January 2026. The top 20% of American earners now account for 57% of all consumer spending. That's the headline number. But here's what that actually means. The bottom 80%, that's 8 out of 10 people, are responsible for just 40% of spending, 43% for 80% of the population. To put this in historical context, in the 1970s, the top 20% controlled roughly 35 to 40% of consumer spending. We've gone from 35% to 57% in about 50 years. The concentration has never been this extreme in recorded American history. But the Dallas Fed number isn't the only signal. It's part of a pattern. Let's look at the job market. 2025 just closed with 584,000 jobs created for the entire year. 584,000. Now compare that to recent years. 2024 added 2.2 million jobs. 2023 added 3 million jobs. 2025, 584,000. That's a 73% collapse year over year. This is the worst job growth since 2020 during the pandemic. And excluding the pandemic, this is the second worst year since the 2009 Great Financial Crisis. The labor market isn't slowing. It's already in recession territory. They just haven't called it that yet. Next, consumer confidence. The University of Michigan Consumer Sentiment Index is at recession levels. But here's what makes this particularly dangerous. For the first time since the 1970s, consumers are reporting simultaneous concerns about inflation and unemployment both at the same time. Think about what that means. In a normal recession, people worry about losing their jobs. Prices usually stabilize or fall. In a normal inflation period, prices rise, but jobs are plentiful. What we have now is both. Prices still elevated, job market collapsing. This combination hasn't happened since the 1970s. Stagflation, and if you know your history, you know how that ended. Double-digit inflation, double-digit unemployment, economic disaster that took a decade to resolve. Here's another signal most people missed. Social Security claims. Baby boomers are claiming Social Security benefits early, not at full retirement age of 67. At 62, the earliest possible age. Why? Because they're afraid they won't have jobs until 67. They're claiming early out of fear, not choice. And when people make that decision, it tells you something about their confidence in the economy. It also accelerates the depletion of the Social Security Trust Fund, which is already projected to run out between 2033 and 2035. Then you have the structural indicators, childcare facilities closing nationwide, not because of regulation, because parents can't afford them anymore, small business failures increasing, credit card debt hit a record $117 trillion, auto loan delinquencies rising, personal savings rate collapsed. These aren't isolated data points. This is a pattern of systemic stress concentrated entirely at the bottom 80% level. Here's what the Dallas Fed gave us. They gave us confirmation that the economy has split into 2 separate systems. One system, the one that includes the top 20%, is functioning. Asset values growing, stock portfolios expanding, real estate appreciating, wealth compounding. The other system, the one that includes everyone else, is breaking, jobs disappearing, wages stagnating, savings evaporating, debt accumulating, and the gap between these 2 systems is widening every single month. Now, here's the critical part that most analysts miss. These 2 systems cannot coexist indefinitely. They're not parallel economies that can just run forever. And the elite system depends entirely on the mass system continuing to function. The top 20% needs the bottom 80% to work in their companies, buy their products, rent their properties, service their needs. Right now, the mass system is failing, and when it fails completely, the elite system goes with it. because you can't have a consumer economy where 70% of GDP depends on consumer spending when 80% of consumers don't have money to spend. The Dallas Fed didn't just give us a number, they gave us a snapshot of an economy in the process of breaking. Stage 3, system breakdown. The foundation cracking while everyone pretends the building is fine. If you're starting to see how all these pieces connect, hit subscribe because what comes next isn't random, it's mechanical. And we're going to walk through exactly why this structure cannot hold. Now, here's the part they don't talk about in the financial media. Here's the part that makes this situation not just unfair, but mathematically unsustainable. Consumer spending is 70% of US GDP. 70%. That means the entire American economy, the largest economy in human history, runs on people buying things. Not government spending, not exports, not investment, consumption. People buying food, housing, cars, clothes, services. That's what keeps the machine running. And right now, 57% of that spending comes from just 20% of people, which means 43% of spending is being done by 80% of the population. Let's do simple math. If you're in the top 20%, your household income is roughly $130,000 and up. If you're in the bottom 80%, you're averaging somewhere between $40,000 and $80,000. The top 20% are already spending aggressively. They're buying houses, cars, vacations, investment properties, private school, healthcare, entertainment. But here's the ceiling. You can't eat 4 times more food. You can't buy 4 cars every year. You can't live in 4 houses simultaneously. You can't get 4 haircuts a week. There's a physical limit to how much any individual or household can consume. The top 20% spending more cannot compensate for the bottom 80% spending less. The math doesn't work. The volume isn't there. And this is where the system breaks. Here's what makes this truly fragile. The elite economy depends on the mass economy. It's not separate, it's built on top of it. Luxury brands need middle-class workers in their factories. Real estate investors need renters who can pay rent. Stock portfolios need companies with customers who can buy their products. Even high-end service industries need functioning infrastructure maintained by working-class labor. The top 20% cannot exist in isolation. Their wealth is built on systems that require the bottom 80% to participate. When the bottom 80% stops functioning, stops spending, stops working, stops reproducing the system, the entire structure collapses. There's no escape hatch. There's no parallel economy the elite can just move to. And here's the trajectory problem. Right now, we're at 57% concentration, but this number isn't static, it's moving. In 2015, the top 20% controlled roughly 45% of spending. By 2020, it was around 50%. Now in 2025, it's 57%. The gap is widening fast. So what happens when it hits 70%, 80%? At what point does the bottom 80% have so little spending power that the consumer economy just stops? When do companies stop producing goods because there aren't enough buyers? When does the labor market collapse completely because there's no demand for workers? And here's the death spiral. As the bottom 80% spends less, companies targeting that market fail. Jobs disappear, those people earn even less. They spend even less. More companies fail, more jobs disappear. It's a feedback loop, a self-reinforcing cycle of economic contraction. Meanwhile, the top 20% don't create enough demand to absorb the excess labor. They don't need that many workers. They don't buy that many products. You get structural unemployment, permanent joblessness, you get demand destruction, and you get economic collapse. This isn't theory. This is mechanics. This is how economies break. We've seen it before, the Great Depression. When farmers and factory workers couldn't afford goods, demand collapsed. Companies failed. More workers lost jobs. The spiral continued until the entire system broke. Japan's lost decades. Aging population combined with wage stagnation created a demand-death spiral. 30 years of economic stagnation still ongoing. The pattern is always the same. When too much economic power concentrates at the top while the base erodes, the structure becomes unstable and instability resolves always. It resolves through collapse, restructuring, or both. Right now, the American economy is a pyramid standing on an eroding foundation. The top is getting heavier, the base is getting weaker, and everyone's pretending that somehow this is sustainable, that somehow the laws of mathematics and economics don't apply this time. They do. They always do. And the resolution is coming. So, what does history tell us happens next? Because this pattern, extreme wealth concentration leading to economic collapse, isn't new. It's ancient. It's one of the oldest patterns in civilization. And it has never, not once, resolved peacefully. There's a pattern that repeats itself across centuries, a four-stage pattern that has destroyed empires, collapsed currencies, and reshaped civilizations. We've seen it in Rome, in France before the revolution, in Weimar Germany, in the Soviet Union, and we're watching it execute in America right now. Stage 1, elite capture. This is when economic and political power concentrates in a small elite class. It happens gradually. Tax policy starts favoring the wealthy. Regulatory capture allows monopolies to form. Lobbying ensures government serves elite interests first. The system begins working primarily for those at the top. But it's not obvious yet because the general population is still doing okay. Jobs are available. Wages cover expenses. Life continues normally. Rome had this. The patrician class controlled the land and the Senate. The plebeians still had some economic participation, some upward mobility. Stage 1 can last decades. It feels stable. Everyone assumes this is just how things are. Stage 2, resource extraction acceleration. This is when the elite start extracting wealth faster than the economy can regenerate it. Wages stagnate while productivity rises. In the US, productivity has increased 80% since the 1970s. Wages flat. Asset prices inflate beyond what wage earners can afford. Debt becomes necessary for basic living. The middle class begins shrinking. In this stage, the bottom 80% start feeling the pressure. They're working harder, but falling behind. They take on debt to maintain their lifestyle. The system is still functioning, but stress is building. Cracks appear. France before the revolution had this. The nobility were exempt from taxes. The peasants paid increasingly higher rates. Debt accumulated. The economy was still running, but the foundation was weakening. The key indicator of stage 2, the elite believe they can extract indefinitely. They don't see the breaking point approaching. They assume the system will always provide. Stage 3, system breakdown. This is where we are now. This is when the mass population can no longer support the system. The bottom 80% hits survival mode. And here's the evidence. 57% spending concentration. That's the signature of stage 3. Job market collapse. 584,000 jobs in 2025. That's contraction, not growth. Consumer confidence showing dual concerns about inflation and unemployment. That's the 1970s parallel. That only happens in stage 3. Social security claims happening early out of desperation. Credit maxed out, savings depleted. These are all stage 3 indicators. In stage 3, the economy stops growing organically. It only appears functional because of artificial supports, central bank money printing, government deficit spending, elite asset appreciation divorced from the real economy, debt accumulation at every level. But it's artificial. The foundation is cracking Weimar Germany from 1920 to 1923. The government kept printing money to maintain the appearance of function while the real economy collapsed underneath. Workers got paid twice a day because their wages were worthless by evening. That's stage 3. Stage 3 can last 2 to 5 years. It ends when one of two things happens. Either the elite voluntarily restructure the system, or the system breaks. History shows us the first almost never happens. The elite don't give up power willingly. So we get the second option. Stage 4, collapse or revolution. This is the resolution. And history shows there are only a few ways this resolves. Option A, currency collapse. Hyperinflation destroys the savings of the bottom 80%. The elite who hold hard assets survive and consolidate even more power after the collapse. Weimar Germany, Zimbabwe, Venezuela, same pattern. Option B, political upheaval, social unrest, regime change, violent restructuring. France, 1789, Russia, 1917. The pressure builds until something breaks, and when it breaks violently. Option C, controlled demolition. The system is allowed to collapse, then rebuilt with new rules. The Great Depression leading to the New Deal. This requires a crisis severe enough to break elite resistance to reform. It requires the elite to accept restructuring because the alternative is losing everything. In every case, stage 4 means the bottom 80% loses catastrophically before any restructuring occurs. The elite don't give up power until the alternative is total destruction. That's the historical pattern every time. Right now in January 2026, we are deep in stage 3. The concentration metrics confirm it. The job market confirms it. Consumer confidence confirms it. The stress in the system is obvious. The question isn't whether we reach stage 4. The question is which version of stage 4 we get and how soon. The evidence that stage 4 is approaching is political polarization at extremes, trust in institutions at historic lows, economic stress translating directly to social stress, government dysfunction increasing. When the bottom 80% can't afford to eat, clothe, and house themselves, while the top 20% lives in unprecedented luxury, something breaks. It always does. So, what does stage 4 actually look like when it arrives? And what does it mean for your money, your job, your family? Let's talk about what stage 4 actually means. Not abstractions, not theories. What happens to your paycheck, your savings, your home when a $28 trillion consumer economy built on the bottom 80% finally breaks? There are 3 possible paths. Let's walk through each. Path 1, deflationary collapse, the Great Depression model. The bottom 80% spending drops below critical threshold. Companies can't sell products. Mass layoffs begin. Layoffs reduce spending further. More companies fail. More layoffs. Death spiral that accelerates until system seizes what it looks like. Unemployment 15 to 25%. Asset prices collapse 40 to 60%. Deflation sets in. Prices fall, but nobody can buy because no jobs. Credit freezes. Banks won't lend. Businesses can't operate. Government tax revenue collapses. Who wins? Who loses? Bottom 80% lose jobs, homes, savings, everything. Top 20% lose asset values temporarily, but have cash to survive. When assets hit bottom, they buy everything. Real estate, stocks, businesses at pennies on dollar, depression playbook. Wealthy consolidate more wealth during collapse than before. Path 2, inflationary collapse, stagflation model. Government prints its way through stage 3. Fed keeps rates low, buys bonds, expands money supply. Currency loses value faster than economy adapts. What it looks like. Prices rise 20 to 50% annually. Wages can't keep up. Salary increases 5%, but rent up 30%. Food costs double. Savings evaporate in real terms. Essential goods unaffordable for bottom 80%. Social unrest builds as purchasing power collapses. Who wins? Bottom 80% destroyed. Fixed incomes, cash savings, wages become worthless in real terms. Top 20% own real assets. Real estate, stocks, commodities. These inflate with currency. Wealth protected. Weimar lesson. Cash holders wiped out. Asset holders transfer wealth from everyone else. Path 3, controlled crash and restructuring. New Deal model system allowed to break partially. Painful recession 2 to 4 years. Unemployment 10 to 15%. Asset prices fall, crisis becomes undeniable. Political will emerges for restructuring because alternative is revolution. Restructuring looks like tax restructuring, wealth taxes, higher corporate taxes, social safety net expansion, unemployment benefits, healthcare, labor reforms, minimum wage increases, union protections, financial regulation. Goal is rebuild bottom 80% purchasing power. Make economy functional by ensuring mass population can participate. Who wins? Bottom 80% suffer during crisis, unemployment, foreclosures, bankruptcies, but system rebuilt to function for them. Top 20% forced to accept smaller slice in exchange for stable system. They fight at every step, but accept it because alternative is revolution or total collapse. The 1930s outcome. Elite fought New Deal viciously, called it socialism. Eventually accepted it because alternative was losing everything. Which path are we on? Evidence suggests path 1 or 2 or combination. Deflationary signals, job market collapsing, consumer confidence falling, credit stress rising. Point to path 1. But inflationary risks, government running massive deficits, Fed balance sheet over $7 trillion, political pressure to spend more, print more. Point to path 2. Most likely hybrid deflation in real economy, jobs disappearing, wages stagnating, demand falling, but inflation continuing in essentials. Food, energy, housing, things you can't avoid, stagflation, worst outcome for bottom 80%. Losing job while rent goes up, taking pay cut while food prices double. What this means for you specifically, bottom 80% job at risk. especially consumer F-facing industries, retail, hospitality, services companies selling to bottom 80%, fail as spending power disappears, savings losing value, cash, vulnerable home if over-leveraged at-risk expenses, essential costs consuming larger income share options, shrinking ladder up gets pulled away, top 20% assets volatile but likely recover over long-term income more stable but depends on whether source relies on bottom 80% consumption. Opportunity buying power increases as assets cheapen risk, social instability, political risk, potential wealth taxes, or restructuring. What you can do: bottom 80%, reduce debt now while you have income, build emergency cash reserves, 6 to 12 months expenses, minimum develop skills that work across systems, trades, healthcare, essential services. Don't assume system saves you position to survive. Independently build community connections, mutual aid networks, matter in collapse, top 20%, diversify from pure financial assets, hold inflation hedges, real estate, commodities, precious metals. Don't assume asset values permanent. Consider social and political risk as economic risk. In stage 4, being right doesn't protect you from systemic breakdown. Universal advice: system breaking not because of conspiracy, but because of math. 57% concentration unsustainable. Bottom 80% can't spend what they don't have. Top 20% can't carry economy alone. Something breaks. Question is whether you're positioned for the break. This is not prediction. This is pattern recognition. Setup complete, trajectory locked, only variable is timing, and based on every historical example, stage 3 doesn't last long once concentration reaches these levels. So let's close the loop. January 2026. The Dallas Federal Reserve confirms what many suspected, but few wanted to say out loud. The American economy now runs on the spending power of just 20% of the population. 57% of all consumer spending controlled by 1/5 of earners. 584,000 jobs created in 2025. Worst year since pandemic. Second worst since great financial crisis. Consumer confidence at recession levels. Dual concerns about inflation and unemployment. Social security depletion accelerating. These aren't isolated data points. This is stage 3 of a 4-stage pattern that has destroyed every economy in history that reached this level of concentration. The mathematics are clear. A consumer economy where 70% of GDP depends on spending cannot function when 80% of population lacks spending power. The top 20% cannot spend enough to compensate. They don't need 4 times more food. They can't consume 4 times more services. They can't live in 4 houses. And their wealth, their asset values, their stock portfolios, their real estate holdings, all depends on systems requiring the bottom 80% to participate, to work, to buy, to consume. When the bottom 80% stops functioning, the entire structure collapses. Not because of politics, not because of policy, because of mechanics. We've seen this before. Rome's wealth concentration led to empire collapse. France's elite extraction led to revolution. Weimar's economic breakdown led to hyperinflation and political catastrophe. Soviet system dysfunction led to sudden implosion. Pattern consistent across centuries. Extreme inequality leads to system instability, leads to violent resolution. Every single time, the elite believed it would be different for them. Every single time they were wrong. Right now, while financial media talks about stock market highs and soft landings, the actual economy, the economy 80% of people live in, is breaking. The 2-tier split is not stable, not a new normal. It's a transition state, an unstable equilibrium resolving toward collapse. Only question is which version of stage 4 we get and how fast it arrives. You have a choice. You can believe this time is different, that somehow America will be the first economy in history to sustain 57% wealth concentration without consequence, that the bottom 80% will quietly accept stagnation while top 20% lives in unprecedented luxury. Or you can look at the pattern, look at the data, look at history, and understand that resolution is coming. The British population didn't understand when their capital was already building. German population didn't understand during Weimar that their hyperinflation was deliberate policy. American middle class doesn't understand now that the system has already shifted away from them. But pattern doesn't require your understanding. It simply executes. This is not about fear. This is about seeing clearly. Dallas Fed gave us confirmation. Jobs data gave us trajectory. Consumer confidence gave us timeline. We are in stage 3, stage 4 approaching. And unlike every previous time this pattern ran, this time we have information to see it coming. Whether seeing it changes anything, that's up to you. Subscribe now if you want to understand what triggers stage 4. There are specific signals, measurable events that mark transition from system breaking to system broken. We're going to cover every single one in the next video. You'll want to know when bottom 80% crosses point of no return, when elite realize they can't extract anymore, when political system stops being able to paper over economic collapse. Hit subscribe. Turn on notifications. This isn't slowing down. Concentration accelerating, math locked, pattern executing. Stage 4 doesn't announce itself. It just arrives. If this video made you see the economy differently, hit like button. Leave a comment. Are you in the 57% or the 43%? Because that answer determines everything about what comes next. Because it is arriving, and unlike every time before this time, you have opportunity to see pattern while still executing, rather than understanding it only after collapse is complete. You type,